Welcome to the Nichols Tax Update for October 19th, 2020. This program is produced to provide current information about developments in United States tax law, cases, rulings, IRS pronouncements, and expert comments on hot topics. You are receiving it as a member benefit from the South Carolina Association of CPAs. My commentary is necessarily brief, and you should consult appropriate authority before taking a position on any item discussed in the program. I acknowledge the value here of my subscription to Tax Analysts Today and Tax Analysts and Tax Notes Today, the preeminent source of information for tax professionals in my preparation of this program. Let's get started. What is in this edition? 6 items, interesting, some requiring a little bit of conversation. So let's start with Estate of Jones. This TC Memo 2019-101. Wait a minute, this is 2020. Well, Estate of Jones is still in process. They haven't decided yet, but it's pretty clear that the court is considering tax-affected earnings, and that's a big deal. I'll explain more about it. Treasury Regulation 9913, final regs defining qualifying relative. What and who is a qualifying relative, and why do I care? The Morningstar Packing Company, LP, got into it with the Internal Revenue Service because they had a difference in their business cycle, which ran from October to July, and their federal tax reporting period, which was the calendar year. And at the end of the business cycle, they tore down their equipment, sanitized everything, made sure it wasn't going to, they replaced worn parts so it wouldn't break when they started the new season. Where did the costs go? We'll talk some more about that. NCA Argyle allocated a legal settlement to their advantage, and the court said the allocation between adversarial parties is good, even though it included items that otherwise would have been ordinary income. Thomas Watts, the Danielson Rule applies. Mr. and Mrs. Watts and sold their interests in a partnership. They structured the transaction. It turned out not to be exactly what they thought, and so they wanted to change it. The Danielson Rule says the taxpayer is stuck with the form of transaction they chose. When you choose the form of transaction and you negotiate the transaction, you execute all the documents, and then when the IRS comes calling and you realize you made a mistake, you can't fix the transaction. Tax law doesn't work that way. Finally, some propaganda from the National Taxpayers Union with an issue brief. I want to talk about their conclusion that the tax code progressivity has been enhanced by the Tax Cuts and Jobs Act, also known as the Trump tax cuts. Not to talk politics, just to give them their common name. Tax-affected earnings is gaining acceptance. In Estate of Jones, Tax Court Memorandum 2019-101, taxpayers are looking for solid grounds to discount earnings from a pass-through entity. That discount should take into consideration amounts of estimated federal income tax burden, certainly for gift tax purposes, in the right circumstances, and that could soon have more reason for confidence pending a decision of the tax court in Estate of Jones. But indications are that the Jones court is considering opinions in Kress from the Eastern District of Wisconsin back in 2019, and from Estate of Cecil, which is still on appeal. It's been reported, but it's still on appeal. Not yet numbered, not yet decided. Everyone agrees, apparently, all of these cases agree that a projected stream of earnings may be discounted by the estimated income tax that would reduce the net cash available to the person receiving an interest in a pass-through entity as a gift. That's an important change from the way the law has been administered. And And I understand the reluctance of courts to adopt a tax-affected earnings rule. The problem is you don't know when the tax law is going to change. You don't know when a rate may change. You don't know when the taxpayer's circumstances may change. And so there is no certainty to the tax rate that you might use to give tax effect so that you can tax affect the earnings. I understand why the courts have held that position for so long, but it appears to be losing favor. How they will deal with the uncertainty is not clear, but we should all be aware that in valuing the gift of an interest in a pass-through entity, we may consider discounting that value for the income tax that will burden the projected stream of earnings. It's that simple and that straightforward. Now we have official final regs defining a qualifying relative. Boy, what a dust-up this has been. I think we've talked about the regs defining a qualifying relative at least 3 times in the last 3 months. This is Treasury Decision 9913. It clarifies the definition of a qualifying relative for purposes of various provisions of the tax code for tax years 2018 through 2025. It doesn't so much clarify the definition as it clarifies what the exemption will be for this qualifying relative. Hold on to your hat. The final regs provide that in determining whether an individual is a qualifying relative for purposes of various tax code provisions that refer to Section 152, in years in which the exemption amount is 0, the Section 151D exemption amount will be the inflation-adjusted Section 152D1B exemption amount in the annual revenue procedure setting forth inflation-adjusted items that's published in the Internal Revenue Bulletin. Thus, the exemption amount for a qualifying relative for 2018 is $4,150. What? That's what it says. Maybe it would help if we know what a qualifying relative is. Code Section 152A defines a dependent to include a qualifying relative. So a qualifying relative is one of the class of dependents. To be a qualifying relative, an individual must have gross income less than the Section 151D exemption amount for the calendar year. That's the income test. And receive more than 1/2 of their support from the taxpayer, claiming the individual as a qualifying relative. That's the support test. That's Code Section 152D1C. The tricky part, and what throws a lot of people off, is the individual does not need to be related to the person claiming the exemption at all. A qualifying relative can be the taxpayer's companion if the person meets the tests above. I call it the girlfriend rule. You pick your own title for it. Off-season maintenance applies to future years, not to past years. You ran the equipment. In this case, you processed tomatoes, and you processed tomatoes from October through July. Then you stop. But your tax year was December 31st. Your tax year was in the middle of the tomato production year. So you stop in July, and you have what we used to call in the Marine Corps, dungaree liberty. We tear everything apart, we clean everything, we make sure it's going to be ready for service when the season starts again in October. So are those expenses accruable in year 1, or are they attributable to year 2? Cleanup and restoration for these 2 partnerships, just packaged tomatoes. The court says, agreeing with the Internal Revenue Service here, that those expenses are deductible as part of the new season inventory, not the prior season. That the expenses to put the equipment in good shape and get everything ready are not repairs of the prior that would relate to the prior year work, but instead are anticipating getting all the equipment ready for the next season. Court found the liabilities for accrued production costs were not fixed at December 31st, so you couldn't possibly claim a deduction in the year that ended December 31st. In the middle of the tomato processing season, you'd have to claim your deduction in the following year when all of the expenses that you had incurred would have fixed the liability. Pretty interesting. If not, I think the tax law is fascinating. You may or may not agree with me. Every week we find things, some things that reinforce what we knew. We find some things that are new. We find some things that cause us to say, what? Does it really work that way? So these tomato processing plants can deduct the costs, their off-season costs, as the cost of getting ready for the next year, not the cost of cleaning up after the past year. This one is worthy of your attention. This is important. NCA Argyle LP, TC Memo 2020-56. This is by the way, this is back in May. I picked it up because Robert W. Wood wrote an article for Tax Notes Today. It shows up on October 15th if you're interested. So what's the deal with NCA Argyle and why do I think it's important? NCA Argyle got in a dust-up with their partners, and they sued the partners, and they won a significant judgment. The partners appealed. Now, the amount of money that NCA Argyle is going to receive or not is not certain, nor is the allocation that the trial court put on the award certain either. Nothing is certain. So NCA Argyle and its former partners enter into negotiations in which NCA Argyle gets money and they give up interest in real property. That's a capital gain transaction. But wait, the award at trial included significant punitive damages. Can I turn punitive damages into capital gain while the case is on appeal by agreeing with the other side that we're going to make an allocation that doesn't include allocating anything to punitive damages? Yes, you can. NCA Argyle LP, TC Memo 2020-56 emphasizes the importance of what you negotiate in settling a lawsuit. Make sure that you negotiate, if you can, as little to ordinary income items as you can. Now, an old friend, the Danielson Rule, came out of the Third Circuit back in the 60s. Our taxpayer was trying to claim substance over form. But taxpayers don't get to do that. The commissioner gets to do that, but taxpayers don't do that. You selected the form, sucker, and so you got to stay with the form you selected. Thomas Watts, Mr. and Mrs. Watts, wanted to recharacterize a transaction in which they disposed of partnership interests, which would allow them a more favorable tax treatment. The IRS determination was based on the terms of the original purchase agreement, and the court sustained the IRS treatment. Where taxpayers have a choice in structuring a transaction, the Danielson Rule requires them to abide by the terms of the transaction they chose. There are no mulligans here. Well, just a little bit about the Danielson Rule, if you have a moment. Third Circuit, 1967, Danielson, selling shareholders were held to an allocation of sales price in the original contract for the sale of their shares. This decision denies taxpayers the substance over form argument, reserving that, as I said, for the Internal Revenue Service. But we encounter exposure to the concept of the Danielson Rule when we are working for a client that is either buying or selling a business. Code Section 1060 stands for the proposition, and it imposes a reporting requirement on both buyer and seller to allocate the money that's changing hands in a transaction by negotiation, so that buyer and seller each report the allocation the same way. And the buyer and seller file a Form 8594, and they report the same allocation. So really there is a disincentive, by the way of having already reported the transaction, to try to change it. Where we get in trouble, and where I've had clients get in trouble, they have a lawyer that says, don't bother with the allocation. Don't worry about it. If you insist on an allocation, you'll upset the other side, you'll blow the deal. And so you don't allocate as part of closing. So now both buyer and seller are mandated to file this Form 8594. Are you going to go back to the other side and now try to negotiate what you're going to put on the 8594 post-closing? That doesn't make any sense. Get your negotiation out of the way. Negotiate any allocation of the purchase price. And an allocation, by the way, is required. If you buy a going business and you get land and building and machinery and inventory and the receivables, you buy all that, you have to allocate the purchase price. And you and the seller should agree on that allocation, and then you report following the terms of Code Section 1060, which, by the way, takes you into the regulations under 338. That's quite an interesting journey once you get into it. But you're gonna file that allocation on a Form 8594. Buyer and seller both file it the same way. The attorney should get it at closing. Everybody should button that up so that it doesn't come up to bite you later. Did the Tax Cuts and Jobs Act increase tax code progressivity? This is a memorandum from the National Taxpayers Union. I believe from reading the material that they must be a conservative think tank. They posit that the number of filers with no federal income tax liability increased from 2017 to 2018 due to provisions of the Tax Cuts and Jobs Act. And of course, you got the $24,000, now adjusted for inflation, more than that, standard deduction for a married couple. You got a lot of other changes that the National Taxpayers Union says have reduced the number of people who file returns and pay tax. So that the expanded standard deduction, so the tax code was made more progressive and decreased the income tax liability for low-income filers. And of course, there are tax credits and other things that decrease even the obligation of a low-income individual to file a return. The principal regressive factor that the National Taxpayers Union chose not to discuss is the Social Security program, in which if I make $24,000 a year, I'm going to get hit with a certain amount of Social Security. If you make $240,000 a year, your first $24,000 is going to carry the same Social Security burden that mine does, right? And you're probably going to have some supplemental investment tax as well. So when you talk about the progressivity of the tax code or not, you need always to consider more than the income tax rate. You should also consider Social Security, and you should consider the various credits that are available to a lower income taxpayer with family to see the extent to which the tax code could be called progressive. Well, gang, until next week, for the South Carolina Association of CPAs and me, please stay safe.